Hey everybody, and welcome back to H Invests. So today we're covering Unilever. This is a massive food products conglomerate, and it is available on the London Stock Exchange, the Amsterdam Stock Exchange, and also in New York as an ADR. So why are we analysing Unilever today? Well, Unilever did very well on my strict dividend filter. I did a video on that last week where I use very harsh metrics to screen for quality dividend companies. Usually there's only about 1% of an index that passes the dividend screener at any given time. And Unilever did very well on the UK screener. So as we can see, they came fourth highest in yield on the UK market. They've had great dividend increases in the past. Their turnover is looking a little flat, but they've actually managed to generate more profit over the last 10 years through a higher operating margin. So it's 5 consistent years of dividend growth, which isn't bad. 1.8 times covered by free cash flow. So let's take a look and see if Unilever are a buy. So as I mentioned, Unilever are basically this massive food and personal care conglomerate, let's call them. They have many brands. Here are some of their brands that I think are most prevalent in the US. They're actually third largest company in the FTSE 100 by market cap, behind AstraZeneca and Royal Dutch Shell. And their revenue is actually quite diverse. Like, I didn't realize this, but almost half of their revenue comes from emerging markets. We've got Asia, Africa, Middle East, and then some other countries in Eastern Europe. It's only the other 55% that come from the Americas and Europe, which is actually quite promising, because when you're selling these kind of products, when you're selling them in emerging markets, you've got 2 catalysts for selling more products. Obviously, you've got more population growth, and then you've also got more increase in living standards. So obviously in the West, the birth rate is pretty much just replicating itself. You don't have big increases in population. And also most people are already rich enough to comfortably afford Unilever's products. But if you're in a country with a massively growing middle class, that can be a massive catalyst for Unilever to increase their revenue. And they're also quite diversified in terms of source of revenue. So it's 42% beauty and personal care, 37% food and refreshments, and then 21% home care. So I thought I'd take a quick look at Unilever's operational performance. We can see that turnover has been pretty flat, as I mentioned in the previous slides, but we have seen higher profit achieved by higher operating margins, which is good. And you can see an upward trend in net profit as well, except the last 2 years haven't been so great. I didn't want to cover the whole balance sheet, but I just wanted to take a look at their debt position. You can see their net debt to EBITDA. It did have a pattern of increasing quite a lot in the last few years, but it's still below 2. And a lot of people, you know, they account that the threshold below 2 is pretty sustainable. So I'm happy with Unilever's debt level. Its debt to free cash flow is only about 3.3, 3.4, which is a very sustainable level. So I don't think Unilever have any problem being over leveraged. So, question of the day, here we go. Do Unilever have an economic moat? I think they do. I think there are a couple of sources of economic moat. You've got brands and their intangible assets. So here are a couple of examples. People love to associate food with positive emotions, and Unilever have a very diverse portfolio of these brands. You've got Marmite, which is very popular in the UK. A lot of people say love it or hate it, but that's right. Like, the people that love Marmite really love it, and they have a lot of brand loyalty. Same with Ben & Jerry's, luxury ice cream, right? People know what they're buying when they buy Ben & Jerry's. They buy the luxury, and they buy it for that feeling of feeling good when they consume good ice cream. And the diversity of the brand portfolio makes it much less risky. It's not like, oh, like, you know, our whole brand is Apple, and if something happens that really damages Apple's brands, then Apple's going to get much more screwed over than Unilever. I've got thousands of different brands all around the world, and most people don't know that those brands all operate under the Unilever umbrella. We've also got scale advantage. This is a really interesting one. So Obviously, Unilever are one of the largest product companies in the world. And this means that they've got more cash flow to, one, like innovate these products, and two, pay for slotting fees. And what slotting fees are is basically when Unilever is trying one of its new innovative products, it can pay more to have its products in a prime position in a supermarket so that more people can try them out. So it can get its new products in the eyes of the consumer, but it also has more cash flow to innovate, to build those new products. So it's just going to have a much more bargaining power because it has the money over some like small independent dairy or biscuit producer that might not have that same scale to say, oh, we can pay millions to like get our product, you know, in front of the eyes of consumers all around the country in your shops at eye level. So that's a very, very important economic moat that Unilever has. And it's continued to sustain that economic moat for absolute decades. What about the risks? So as you can imagine, Unilever are a pretty non-cyclical industry. You know, buying these food products, buying these drug products, it tends to be the norm and it tends to be pretty consistent. You can see their turnover was barely affected by the last recession. If you look at 2008 to 2009, I mean, yeah, there's like a 2% drop, but that's a 2% drop compared to other companies that lost, you know, 20, 30% year-on-year revenue in that time. But every company comes with risks. Here's a really interesting one that I identified with Unilever. So you can see here some data concerning supermarkets. These are just supermarkets in the UK. It was easiest for me to find the data from the UK, and because I was from there, I understand the trend best in the UK. But as far as I'm aware, this trend is happening globally. So these budget supermarkets have gained massive amounts of market share in the UK. It's a shame I couldn't find more longitudinal data on this either. But what it is showing is that year-on-year growth for each supermarket in the UK, you can see the two that absolutely beasted it were Lidl and Aldi. And what do they have in common? They're a budget supermarket, and they are taking market share away from the classic old business model supermarkets. You can see that in just 1 year, like Aldi's market share went from 8.8 to 9.5, and Lidl's went from 5.6 to 6.3. Now, in just 1 year, for a small company to gain that much market share in a very kind of old and stable industry is pretty impressive. And for them to have this growth compared to the rest of the supermarkets, which are basically not growing, you know, they're just kind of maintaining their turnover, is absolutely crazy. Why am I talking about this? Well, there's a problem when it comes to Unilever. Because Unilever have these branded products, a lot of these budget supermarkets, they're able to save a lot of money by manufacturing their own products. So they just cut out these product producing companies such as Unilever. Here's an example. So you've got Persil, the washing up liquid, which is a Unilever brand. And then you've got Magnum, which was created by Aldi. And this is a much, much cheaper alternative. And I think things with like washing up liquid, like a lot of people just don't want to pay the premium. Like you can really see that in the growth of these budget supermarkets, right? It's like if Aldi can cut Unilever out and people are not that loyal to this brand, then it can really, really damage Unilever's economic moat. Another massive thing to talk about is inflationary pressures. So I appreciate this graph is a little bit small, but you can see massive, massive commodity inflation. We've seen this all over the place in 2021, but Unilever have put a graph on their own Q3 quarterly presentation in 2021, so they're clearly concerned about this. And it's showing that Brent crude has pretty much doubled in costs, palm oil has doubled in costs, soybeans, obviously they use that a lot for many of their carbohydrates and kind of processed products. That's nearly doubled. Yeah, so we're seeing massive increase in commodities, and Unilever have got a couple of choices. They can either charge higher prices, or they can basically not charge higher prices and accept lower margins in their business. The latter would actually be quite worrying because, as I mentioned, we've got this flat turnover and we've got increasing operating margin, which is supporting increasing net profit and free cash flow. If they didn't increase their prices, their end consumer prices, in conjunction with what they've had to deal with in terms of increasing commodity prices, and their operating margin suffers, that's very quickly going to damage their net profit because they're clearly not relying on growing turnover to support higher profit and free cash flow. They're relying on increasing operating margins. So that's a big worry. But also their high prices. If we actually go and have a look at something in Unilever's quarterly results, they didn't grow volume last year. They only grew by putting prices up on their products. Obviously, Unilever's revenue is going to be the volume of their goods sold multiplied by whatever price they sold those goods at. And you can see here, UVG, which is like the volume growth, that went down by 1.5%. And it was that underlying like price growth, which went up by 4.1%, resulting in this slight increase in revenue for the quarter, which is very worrying because if they're relying on price increases, and then they've got to do even more of that just to maintain their same revenue, it's not really looking good for Unilever either way. So how they deal with this commodity pressure, I imagine it's going to be a mixture between the two, but neither are particularly good options for Unilever. Okay, so quick question. Is the dividend safe? Because I did start this off with as a dividend pitch, and it has got a relatively good yield. So as far as I can see, the dividend looks pretty safe. Whilst we haven't got a very fast growing company here, we've got a company with consistently high turnover and profits. And it's covered by free cash flow. So the long run average is about 1.4, you can see here. And last year their dividend was covered by free cash flow 1.8 times over. So they have a lot of room to cover their dividend. And yeah, from that point of view, the dividend looks good to go and it looks safe. Okay, so we're now moving on to valuation. So here is my DCF for Unilever. First things first, you can see the turnover growth year on year being relatively flat. And actually the analysts, they do think that the turnover is going to go up quite a bit in the next few years, which is promising. However, because of this turnover being flattened out and probably also those operating margins being eroded away because of inflationary pressure, they're seeing a big drop in free cash flow next year, only to recover slightly, but even 3 years down the road, we're still looking at lower than 2020 levels, which isn't great. I put 2 more years into this free cash flow DCF, and I put them at kind of like, you know, high end of 2% growth, just to kind of reflect the rough pattern that's going on here. They are mainly structured by equity, which is good. As I said, they're not too overly leveraged. And the WACC came out at 6.95%, and you can see the shares are fair value. So, I mean, for the shares to come out of fair value with a low discount rate isn't looking that good for Unilever. One other thing to mention as well is that Unilever reports in euros. So you want to make sure if you're looking at, you know, buying Unilever in dollars or buying Unilever in pounds, you've got to use the appropriate exchange rate to get that value in pounds and then compare that to the price on the exchange that you're buying. Here's another thing if we kind of vary the free cash flow growth and vary the discount rate. I thought I was being very generous to Unilever here, offering them between 0 and 4% growth. I'd say 4% is definitely my bull case. My bear case is that Unilever just kind of maintain their free cash flow over the 5 years. And at a 7 or 8% discount rate, that's not looking good for them. Like, the shares are overvalued at that point. We're looking at either £29 a share or £25 a share when they're currently trading at £39 a share. But if you average the case of all my scenarios, again, we're getting fair value, which isn't looking great for Unilever. And now we're looking at forward PE multiple analysis. So obviously the price to earnings is the price of the stock divided by the earnings per share. Therefore, what we can do is we can multiply the PE by the earnings per share to then get the price of the stock. So the EPS for Unilever is being, increasing slowly for the past few years. And the analysts forecast slight increases in the future. Again, I've had to discount these back into pounds because I'm buying on the London Exchange. But you need to do the same. If you're going to buy in the US, you need to multiply it out a bit because obviously $1 is worth less than €1. They have had a pretty consistent price to earnings ratio over the past few years in the range of 18 to 20, which makes it relatively easy to multiply out a forecasted earnings per share by this to get an expected price. Right, where were we before this bloody camera that was on charge ran out of battery? So here's the next 3 years earnings per share. As I said, very, very stable PE. Although analysts are forecasting a lower PE going forward. So if this multiple that we're multiplying the forecast earnings per share by is lower, that could yield a lower valuation. But again, you can see this is coming out at £38 a share, when you average the discounted earnings per share forecast from the analysts and multiply it by the average of the past 5 years PE. I'm using a 7.5% discount rate at the moment to do this as well. 7.5% is pretty low just because Unilever is a pretty stable company, although I just wanted to do a margin of safety and put it slightly higher than WACC that came out at 7%. So, in conclusion, am I buying the shares? It's a no from me this time. So, a few reasons. Obviously, my DCF and EPS models we just looked at were saying the shares were roughly fairly valued, and I was being quite generous to Unilever as well in terms of like growth expectations, particularly compared to their past performance. I also don't see a huge catalyst for like a big share price appreciation. The company doesn't really have that much that's like majorly positive going on right now that I see creating a big uptick in the share price. The dividend yield of 3.6% it is decent, but at the moment there's just too much opportunity cost to hold the shares solely for income. What I mean by that is that, you know, if they were yielding 5% and they weren't growing and they were fairly valued, you might be able to justify it, or if they were 3.6% and growing quickly, you might be able to justify it, but at 3.6%, with not much growth, there's just too much opportunity cost because I can find higher yielding shares that are growing much faster for my income portfolio. However, if the Unilever shares did go down 20-25%, you know, for a reason that didn't really affect the fundamentals of the company, and I was still relatively happy with their business model and what they're doing, I would certainly consider it. You know, if it gave me 5% yield at 25% upside for a relatively non-cyclical business, that would look like a good opportunity. But for now, I'm going to keep a close eye on the shares, and I might buy them if I see an opportunity to get them cheap in the future. I hope you guys found this video useful. Thanks for watching. I've been H Invests, and I'll see you in the next video.